Hello everyone and welcome to Financial Accounting. In this video, we will examine one more business transaction using the Integrated Financial Statement Framework. Today, we will analyze payment of dividends. We have already covered many transactions in great detail. I have a video explaining each transaction and the Integrated Financial Statements Framework basics. I'm posting the link to the playlist here and in the description below. After you watch the videos, it will be easy to understand each transaction and how those transactions affect the three financial statements. The Integrated Financial Statement Framework we will use throughout this video is not just a theoretical concept. It's a practical tool that demonstrates the real-life impact of transactions on the balance sheet, income statement, and statement of cash flows. Understanding this framework will help you see the corresponding relationship among these financial statements, making your financial analysis more comprehensive and accurate. Now let's start with the accounting equation, which is the foundation of our framework. It's a simple equation that you will find easy to remember. Assets equal liabilities plus stockholders' equity. This equation forms the basis of all our financial transactions and statements, making financial accounting less overwhelming and more understandable. The company paid dividends of $6,000. A dividend is a share of profits and retained earnings paid to its shareholders and owners. When a company generates a profit and accumulates retained earnings, those earnings can be either reinvested in the business or paid out to shareholders as a dividend. Dividends is a stockholders' equity account. The payment of dividends decreases cash from financing activities by $6,000 under the Statement of Cash Flows column. Under the Balance Sheet column, cash and retained earnings are decreased by $6,000. After this transaction, the ending balance of cash is $101,000, and the ending balance of retained earnings is $31,000. The balances of land, notes payable, and capital stock remain the same. This transaction doesn't have any effect on the income statement. By adding cash inflows and deducting cash outflows from all the activities, the net increase in cash for the month is $101,000, the same amount as the ending balance since it's the first month of operation. The ending cash balance under the Statement of Cash Flows column of $101,000 equals the cash balance under the balance sheet column of $101,000. By deducting all expenses from fees earned, net income is determined to be $37,000. This equals the net effect of revenues of $52,000 and expenses of $15,000 on retained earnings. The stockholders' investments and revenues increase stockholders' equity, while dividends and expenses decrease stockholders' equity. This is because stockholders' equity is the right of stockholders to the business assets. Stockholders' investments and revenues increase these rights. Dividends and expenses decrease them. Let's check whether the accounting equation balances after all these transactions. Remember that assets must be equal to liabilities plus stockholders' equity. The accounting equation must always balance, as every asset a business owns has been acquired solely from the funds provided by its owners or creditors. Total assets equal $171,000, $101,000 cash plus $70,000 land. Total liabilities equal $40,000, and total stockholders' equity equals $131,000. Total liabilities plus stockholders' equity equals $171,000. The accounting equation balances. Note that the balance in cash on the balance sheet is the same as the ending balance in cash on the statement of cash flows. That's all for today. In the next video, we will prepare financial statements. I hope you found this video helpful. If you did, please subscribe, hit that like button, and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.